Good morning, everyone. Thank you for joining us today. And I first of all want to start by thanking our sponsor today. You just saw the quick little video from Columbia Credit Union. So thank you, Columbia Credit Union, for your sponsorship. We can't do these things without your support and your support throughout the year. Today we have our economic forecast with Robert Dietz. He is with the NAHB. He's agreed to join us today and give us an update. I have seen Robert speak before. I think last year was the last time I saw an update from him. It was actually at the Portland Home Builders. So he's great. He knows his stuff. I think right now is an important time for all of us to kind of understand what is in fact going on. It's kind of a tumultuous time, turbulent time for us. But even just kind of getting a picture of what we see now, what the possibility is. I've been following some of this stuff from Robert, some other economists for the last month. And to be honest, with some of the numbers we've seen, it's been heartening recently. It hasn't been as negative as I thought it might be. And I think it'd be great for all of you to kind of see where we go and see what some of the economists, or at least Robert, has to say about this. I know economists, you can get three of them in the room and they may not agree on anything. But Robert is great, and he actually has, I mean, from what I've seen him a few times, he definitely has the ability to put this in layman's terms so we can definitely understand it and to relate it to our industry. So just briefly about Robert, he's a chief economist of the NAHB, where his responsibilities include, the housing market analysis, economic forecasting of the industry, and running industry surveys to try to get that information, interpreting it, of course, housing policy research. He's also often cited for housing and economic issues in the Wall Street Journal, CNBC, and many other media sources. Prior to joining NAHB in 2005, Robert has worked as an economist for the Congressional Joint Committee on Taxation. He is a native of Dayton, Ohio, and earned his PhD in economics from the Ohio State University. And I'm going to hand it over to you, Robert. Thank you for joining us today.
Great. Thank you very much, Brian. And it's really a pleasure to join you all. Thank you, the sponsor. It's as you noted, it's kind of a difficult time to be in the forecasting game because the forecast that we're laying out is not what we were projecting 3 months ago. I'm going to actually have a slide that shows the degree to which we missed this. I think we have to approach forecasting with a certain amount of humility, given the fact that as early as mid-February, I was saying there's no way there's going to be a recession in 2020 or 2021. We definitely missed the degree to which the virus was going to affect the economy and the degree to which government was going to react. So I'm going to share with you today our national economic outlook. Get this up here on the screen, put it in the slideshow mode. What we've been recommending to builders and people that are in the industry is to basically consume the data and whether it's from us or from anyone else, but with a 2-month, 2-quarter, 2-year perspective. We are at the end of the first 2-month period, which is a period marked by lockdowns, particularly bad economic data. We are now transitioning into what we think is the 2-quarter period, although there's an important footnote to that, to the degree that you see certain states, particularly I'd say Florida, California, Texas, and Arizona, just showing some increases in the virus. But generally speaking, the 2-quarter period is going to be about stabilization and the seeds of an eventual rebound. And while there's a lot of discussion about how quickly the economy is going to snap back, I think, as Ryan indicated, the data are coming in better than what we expected maybe a month and a half ago, but it's still going to take about 2 years for the economy to heal. So this isn't going to be something where we get back, say, by November or December of this year and look back and say, wow, we got through that. We're still going to be dealing with lingering issues, but the news should be improving. One of the things that we're really focused on is the idea that unlike the Great Recession, in this downturn, housing really leads the recovery. We're 15% of GDP when you consider home building and remodeling and home sales and other activities related to housing activity. And we've gotten a lot of good news. And I put that we've had 8 weeks of gains in mortgage applications. is actually 9 weeks now in data from the Mortgage Bankers Association. Housing demand is up. It's certainly being promoted by lower rates, but supply is down. We've seen a 20% decline in listings in most markets. So that's keeping prices up. This is another big difference from the Great Recession, where we had particularly large price declines, where we had building rates of price declines causing foreclosures, which then increased the inventory that caused additional price declines. You don't have anything like that. We entered this particular downturn underbuilt rather than overbuilt. And so some of the same factors that were at play for the last 5 or 6 years remain at play. We're just doing it now in a elevated unemployment situation. A good example of some of the good economic news, we saw new home sales with the April data. We get the May data next week, but the April data came in actually almost up a little bit, almost up 1% year over year. And there's some news, some indications that the May data will be even stronger still. So there are definitely risks to the forecast. The most important is the second wave of a virus. What we're seeing in some of these southern states is not a second wave. It's a rippling of the first wave. So by a second wave, we mean places like New York, like Seattle, places in the northern US that have, for the most part, emerged out of the first wave of the virus. Whether we'll see going into September, October, November, a real uptick in those markets. I think the chance of that, by the way, is kind of 1 chance in 3. Now, I'm not saying that the virus isn't going to spread in the fall, but I mean a really economically damaging uptick in the virus that causes renewed lockdowns at the local level. I think with the development of antiviral drugs, better medical infrastructure in place, we got caught flat-footed at the start of this. We weren't prepared. I think we're in a better shape. So I think the country as a whole is in better shape to be able to deal with the second wave. So the overall forecast is one of a sharp mid-year decline with a relatively stronger rebound for housing. Now, I'll start here with, in terms of looking at some of the data. This is confirmed cases of the virus itself. That's the blue line. Day 1 here actually marks like March 6th. I started doing some analysis on this. The red line is a forecast that I made back then when it looked at what would the virus do in terms of case growth if we were looking at a completely uncontrolled exponential pattern of growth. And we would be in the tens of millions of confirmed cases. And there's good evidence to suggest that for every confirmed case, there's probably 4 or 5 asymptomatic cases walking around. But let's just deal with confirmed cases here. The red line is not what we saw. The blue line is the historical data, and it moves along something, and we can find this in the scientific literature. Viruses spread along something called an S-curve. It's a logistic curve in terms of its mathematics. And that green line is basically my statistical fit of the data using a style of S-curve. And what it has is a fast takeoff, and then it begins to slow as behavior changes, as policies change, as knowledge grows, and frankly, as the virus spreads itself, and it reduces the number of people it can be spread to. And that's what we're moving along. We're moving along this green line. Now, it's been creeping up in the sense that it hasn't really slowed down as fast as maybe an S-curve would suggest. But overall, I think this is good evidence for governors and mayors to begin opening up the economy. And so from 3 weeks ago, you could look at this data and say, yes, it was time to begin to open up. And further on the virus itself, one of the things I haven't seen in some of these websites tracking the data is a good estimate of how many people are walking around and are infected right now that can spread the virus. That's what those gray bars are. They're my estimate based on some of the mathematical models and the underlying data of how many people are currently infected. You can kind of see 3 distinct phases on this slide. There's the phase that ends roughly in the 3rd week of April, and that's the exponential part. That's the front end of the S-curve. And then from the 3rd week in April until roughly the 3rd week in May, you have a decline in the number of people who are infected. And that's the effect of the shutdowns, the lockdowns, and the more awareness and change of behavior. And then a 3rd phase we're in right now, which is kind of, it's either flat or even a slight decline nationwide. And that's, you can see the little uptick at the end. That's kind of what's being discussed in the media right now. But generally speaking, the spread of the virus is within a controlled sense. Because I think the important thing to keep in mind, and this is me as a as an economist speaking rather than a public health official, is that we have to recognize that the goal of flatten the curve was to make sure that the healthcare system wasn't overwhelmed. It was not to cause the virus to move down to a zero infection case. In that sense, I think some in the media are guilty of moving the goalposts. The objective here was to make sure that we didn't have what Northern Italy had, which was the hospitals completely overrun. And if anything, hospital activity and layoffs suggest that we're underusing our medical infrastructure by shutting down. So I'm not trying to be political about this. I think there's a happy medium to be found by policymakers, but I do think the media right now is taking this perspective that any increase in infections is somehow a failure of opening up the economy. And I think that's just dead wrong. The goal here was to reduce deaths, reduce serious illness, and make sure that the hospitals wouldn't be overrun. Why am I going through this in a housing forecast? I think this is really important in terms of trying to forecast what the economy is going to do in the future. We got to have a good understanding of this. The other thing is, I've been in housing economics for more than 2 decades. I feel like I've spent most of that time arguing about with people about urban sprawl, about home construction, the merits of high density development, low density development. And I think one of the things among academics and think tankers, certainly over the last 10 years, was this view that single family traditional suburban housing was bad. Now, I love townhouses. I love medium density, walkable neighborhoods. I live in one outside Washington, D.C., so I'm talking my own book here. But I do think we have to have a broader talk about density, because this data here, all the blue dots are states. And I've plotted on the vertical axis state deaths per million due to the virus, and then a density measure on the horizontal axis. And just a very simple linear fit through it has a really strong correlation. And basically states that have higher density have suffered the virus more. And what this has shown is that the traditional single family home, suburban type neighborhood has proven its resiliency during a public health crisis. It's less reliant on subways. It doesn't have to deal with, like New York, sidewalks and other factors like that. And whether or not that's going to have a conversation about public policymakers and academics, it's certainly going to have an impact on housing demand and where people want to live. And by the way, a footnote to this slide, I didn't even include the New York data, which is marked in red here. If I included that New York line, that line on this graph would be a lot steeper. So I deliberately adapted a very conservative look at the measures. And I think, you know, before we enter into another round of everybody has to live downtown in high-rise buildings, we have to take a look at what neighborhoods really were the best places to be during this environment. So we know that's going to change consumer behavior. We know telecommuting is going to change behavior, but I think that's an important point and a lesson from the current crisis. All right, so this is our current macro look, and that's the focus of this presentation. What do we think the economy is going to do as a whole? We have the first quarter data. First quarter had a negative 5% growth rate. That was the beginning of the recession in March. NBR says February, you know, last week of February, first week of March. So, you know, you can argue about that. The second quarter is that really deep blue bar. That's the quarter we're in right now. Our forecast model says negative 33% growth rate. I think consensus right now is negative 40%. So I'm among the more optimistic folks. I've seen estimates out there that say negative 50%. You know, regardless, it's going to be the worst performing quarter we've had for the U.S. economy since World War II, which was characterized by a deep recession when we moved from building tanks and bombers that started the consumer economy. There was a quick shock to the economy. And that's what we've got here. And you can see there's a gray area. Those are our recession bars. You can see the Great Recession, for example, spanning 2008 through 2009. And the recession here, if we're correct about this and there's no second wave, no double dip, it's a 3-month recession. It is short and sharp. Now, this is a tremendously different recession. I mean, I said at the beginning, we missed this one in terms of a forecast call, but it was, you know, government imposed. This was a recession imposed as a public health strategy. Now, where we've made a change, the third quarter. I've got the third quarter now solidly positive. And a month ago, 6 weeks ago, when we were talking about the third quarter, I thought it would be flat or even down a little bit. And I thought people were focusing a little bit too much on Wall Street firms that have deep pockets and were going to operate better during the rebound. And I was worried about the small business sector. But the incoming data suggests that while there's still a lot of pain, particularly in travel and hospitality, that the small business sector is reopening its doors as well. So we've essentially accelerated some of the rebound into the third quarter. But do keep in mind what I said at the beginning. It's probably going to take about 2 years to get back to trend. And I think, yeah, on this next slide, this is where you can see how wrong I was even 2 months ago. This is probably not an endorsement of doing a forecast, but it's important to point out that that blue line is the forecast that I gave at the International Builders Show, basically the one that we developed in late 2019 for GDP. And you can see the red dashed line is the current projections, including some of the historical data at the start of the year. So the biggest gap, the peak of the recession, which is essentially what we were in last month, was a 10.3% difference in the level of the overall economy. And that's what you would expect when you have, just a complete shutdown of the US economy with moving some of the parts around. They become a big output gap. And then the forecast that I showed you on the prior slide, that's the return to trend. And that red dashed line gets us back to kind of where the red line and the blue line diverge by the second quarter of 2021. So sometime during 2021, we get back to where we were. And then you can see it takes a little bit of time to kind of really get back to the trend growth rate. So, you want to call that V-shaped, U-shaped. I'm not sure some of the, kind of terminology, but it's at least a 2-year type repair effort. In terms of the labor market, there's good news, bad news here. The good news is that there were projections that we would see an unemployment rate of 20, 25%. That didn't happen. In fact, our peak rate for unemployment was like 19% in the model. The data came in and we found a 13.3% unemployment rate. The true number is probably about 16. People didn't fill the forms out correctly. There was no manipulation or politics being played, but the true rate's probably about 16%. And then the good news is by the end of the year, we think it's going to be about 10%. Now, where's the bad news on that? 10% is the peak rate of unemployment during the Great Recession. So yes, it's going to go up very quickly. It's going to come down quickly. And you can see in that red line, it comes down quickly, but it's still by the end of the year near the peak rate of the Great Recession. So it's a challenging labor market. If there's any silver lining to it, it's what I put in the subheading. We know, looking at economic data, that when unemployment lasts less than 6 months, it doesn't change people's buying patterns for houses or cars. So if we can keep people's duration of unemployment fairly short, that increases the probability that the economy will recover quickly. The other thing we're looking at, that's something my team developed, was looking at state level data in terms of exposure and dependency on what we call vulnerable industries. These are industries like travel, tourism, hospitality that have high levels of unemployment. So if you look at the two states that kind of top the list of having exposure, I should probably say 3 states, I've been saying it's 2, but the states that are most dependent on the sectors that have the most concentrated levels of unemployment, not a shock, Nevada, Florida, and Hawaii. The Las Vegas unemployment rate is 34%. It's the highest unemployment rate in the country for a large metro. Travel and tourism. You could throw Louisiana in there with a combination of oil factors and New Orleans tourism. So these states that are in darker colors are going to have a tougher time recovering just due to the nature of social distancing and the virus itself. Now, when we think about the fact that we have a really tough economic environment, but we have not faced a liquidity crisis or solvency crisis, I think we have to give an A+ to the Federal Reserve. They went all in, aggressively cutting rates to 0, restarting quantitative easing. All these factors have kept interest rates low. And I should note that we take the NAHB senior officer team to meet with the Fed Chair Powell, once a year. We met with them at the end of March. It was by teleconference this time rather than in person. And during that meeting, both groups, the NAHB obviously, but the Fed as well, really emphasized the importance of housing as a mechanism by which monetary policy that the Federal Reserve controls helps support the economy. So that's another kind of point that argues in favor of the idea that housing is going to help that lead that rebound going forward. So what does that monetary policy support mean? Well, interest rates are going to remain low for quite a long time. In fact, the last week, the Chair Powell said they're not even thinking about raising interest rates for a number of years. So I think we've got at least a 2-year window, a runway in which the 30-year fixed rate mortgage is going to be below 4%. In the data that came out this morning, the average mortgage rate is 3.2%. That's a historic low. And that's the reason that we've got really kind of bullish signs on housing demand. The other thing that, and I mentioned this earlier, but it's important to keep in mind in terms of building a forecast out, housing had a huge amount of momentum going into the start of this year. So this slide, the blue bars are the growth in the number of homeowners by quarter. The red bars are the growth in the number of renters by quarter. So think back to the Great Recession, basically from 2010 to 2016. This was a rental-led recovery. It's why multifamily construction took off first after the Great Recession. And then it pivots in 2016. We start to move from rental to owner-occupied growth. Why did that happen? The millennials are growing into their 30s in larger numbers. And so the momentum is shifting from the rental side to the homeowning side. And then look at that very last blue bar on this slide. It was the best quarter that we had since the Great Recession for home ownership in terms of demographic tailwinds. So there was a lot of demand side momentum. It was there. Of course, then the virus hits, the recession of 2020 occurs, but you can still see it in the housing demand and the mortgage application data. The demographic tailwinds are very much there. All right, what about the supply side? What are we talking about with in terms of builder data? Well, we like all other industries, home construction lost a huge number of jobs in the April data. We lost 450,000 jobs. That was half of the job gain that we had experienced from the Great Recession to 2020. We had picked up about 900,000 jobs. Labor shortage had impeded that growth. We lost half of them in 1 month. Now, the good news, half of that, in other words, more than 225,000 were gained back in May, which in terms of a rebound was the top among various sectors. So we had some job losses, but we quickly added them back. But the challenge in terms of a skilled labor shortage is a little more complicated now. In the past, over the last 4 or 5 years, we've talked about trying to recruit people into the industry, and we couldn't do so because the unemployment rate was really high, or I'm sorry, was really low. The challenge now is the unemployment rate is high, so we can recruit people, but it's a skilled labor shortage. So the data you're looking at is the measure of worker productivity. It's a measure of skills. And what's interesting from an economics point of view, if you look at the red line, since 2016, it's been going down. Why is worker productivity in construction going down during a period in which we have a labor shortage? Well, it's a natural consequence of baby boomer, skilled professionals retiring and being replaced by younger workers who have fewer skills. So the output per worker has been going down for 3 years. Now, that sounds on its face like a bad thing, but it's actually part of the solution. As we bring younger workers down, worker productivity is going to go down first. It will then rebound. But this really emphasizes the value of membership. You need to be a member of BIA, local associations, state associations who are engaged in worker development, because we've got to train those workers. And this is a moment where we can recruit people in, because you're going to have sectors that are going to have persistently high unemployment, but skilled labor. We have to get the skills up. So that's a challenge on the labor side. In terms of building materials, we're watching lumber pricing. Lumber pricing is a great signal of where the industry as a whole is in terms of demand. The slide ends mid-May, but in the subheading, in fact, I didn't update the subheading. I apologize for that. The current price for lumber is about $460 per 1,000 board feet. That's the current measure. So it went down as we entered in the recession. It's been going up, and you can imagine it going up to about $460 on this slide. We think it's going to level off somewhere $460, $475 per 1,000 board feet. What we've seen was a shutdown of some mill capacity as we entered into the recession. I've been watching the employment data in terms of sawmill workers. We lost about 3,000 of those jobs in April. I'm hoping, and I think there's evidence that we're going to see some of those mills come back online. That'll be good for domestic lumber manufacturing, of course, but also be good for builders to kind of get some stability in lumber pricing. And of course, the Canadian lumber continues to come. We get a third of our lumber supplies from Canada, but the tariff, the 21% tariff, is still in place. So if we get some resolution with a new softwood lumber agreement, that too will help the overall lumber market. The other thing that we're hearing, and this has shown up consistently in our weekly, monthly, and quarterly surveys, is challenges on building materials. There is definitely, it's taking longer to get some products. Some products are not available. It's kind of like what it was like going to the grocery store recently. The shelves aren't empty, but you're not necessarily going to find every product you need when you go. And so I put up some data as an example of that. Kitchen cabinets. This is the import share, where we get imports from kitchen cabinets over about a 20-year period. You can see the growth in the Chinese share up and through 2010. I added the Vietnamese component because one of the things I learned over the last few years is there's a lot of cabinets that say made in Vietnam. They're really made in China. They just ship them to Vietnam, they stamp made in Vietnam, and then off they go. It's a way that China can try to avoid some of the trade rules. But you can see going into 2019, trade wars began to reduce that share. And then we put up the 2020 data through April, further declines in shares of imports from those two countries. In fact, the Vietnamese share grows, not a surprise. This is a good example of what we're going to see through a variety of different products. I think, unfortunately, I'm a free market economist. I like trade, but Chinese-U.S. trade is going to be disrupted for years and years to come, and that will persist even through a vaccine. That is a political consequence. It's going to continue, and that means things like lighting fixtures, plumbing fixtures. We heard about cabinets, other kinds of materials are going to have some lags and leads in terms of their availability, and we're going to be doing some deeper surveying on this particular topic. Another issue on the supply side is the availability of financing for builders and developers in the residential construction industry. This is a survey we do on a quarterly basis. Any score above 0 means that conditions are easing. It doesn't necessarily mean that the pipes are open in terms of loans, but things are progressively getting better. The loan volumes are expanding. And you can see what happened in the first quarter of 2020. It drops down like a lot of other economic metrics. And in fact, according to this particular index, lending for acquisition, development, and construction loans was the tightest it's been since 2011. Now, the good news on this is what builders were telling us, but just yesterday, I finally got first quarter data from the FDIC and was looking at the construction loan lending amounts, and they were up. So it looks like, despite the fact the lending conditions gotten tighter, banks still wanted to be in the business of providing that lending. This is a key issue because we know one of the factors coming out of the Great Recession that slowed the recovery was the inability of builders to get loans when they had demand in front of them because of risk aversion by banks and overstepping regulatory rules on the banking sector. We send this data, by the way, to the White House because I think they have accepted the idea of housing as a leading sector, but we've made it clear to them the private builders can't build unless they can get access to financing. So we're watching this. I hope the second quarter data will match what I saw from the banks, which is a slight improvement as the overall housing market improves. All right, so we'll take a look now at our outlook and forecast. I mentioned it before, but we entered this particular downturn underbuilt rather than overbuilt. We were overbuilt in the Great Recession. And this is historical data that kind of illustrates that. If you look at this, the numbers are the number of single-family homes built by decade per million per year. So like the 1980s, 1990s, and 2000s, we were building about 41,000 single-family homes per year per million population in the U.S. It's a population-adjusted measure. Pretty steady, despite the fact that you had up years and down years and recessions and so forth. And then look at the 20 teens. I'm still not sure what we're calling the last decade. We'll call them the 20 teens here. It falls off to 21,000 single-family homes per million population per year. That left us unambiguously with a housing deficit in the United States. Now, how big it is a matter of dispute. I think NAR believes 4 to 5 million. Freddie Mac has said 2.5 million to 4 million. My team used vacancy rates and demographic data, and we came up with an estimate, including ADUs, supplementing some of that, and young adults living at home. We're probably short about 1 million homes. So a smaller estimate, but I think it's legitimate. It's one of the reasons we've seen consistent home price gains, and we're underbuilt. And so the result is there's underlying demand for construction. And that's reflected in some of the changes that we've seen for the NAHB Wells Fargo Housing Market Index. Now, this came out this week. This is our monthly flagship indicator of how builders see market conditions. And you can see what it's done in recent months. It was in the 70s as we entered into the recession. It dropped down to a level of 30, a 42-point drop, the biggest drop we've ever had in the index, going back to 85. It went up 7 points last month to 37. And then this week for the June reading, it jumped 21 points to a level of 58. Any score above 50 is positive, so we're back in positive territory. And that 21-point jump in June was the biggest increase we've ever had in a single month. Again, short and sharp. I mean, you can just see it in the soft data, like this survey, and the hard economic data. Now, the reason we like the HMI is because it's a pretty good forecasting tool. It moves fairly closely with the ups and downs of overall single-family construction. And you can see we had a big drop in single-family starts. And using the HMI, then we build our forecast around that, including a macro model and a demographic model. And so the numbers that we were looking at before we got the housing starts data yesterday was nationwide, we were expecting about a 15% decline in single-family construction. Now, that 15% decline was better than what we thought 2 months ago. This goes back to what Ryan said at the beginning. I was looking at about a 20%, 20% decline for the industry 2 months ago, just based on demographics and the stock market being really down and projections of really bad unemployment. So we revised up. And then the data that we got yesterday, which was flat and seemed to be portrayed, particularly by CNBC and the Wall Street Journal, as disappointing. Disappointing relative to what? It came in better than our forecast model. You can see the dip that I've got built into the forecast. And in fact, last night I was playing around with some of the numbers. If the pattern that we saw last month continues, which is improvement along like the HMI, that negative 15% when we revise next month could turn into negative 13 or even negative 12%. So I'm not trying to spin, good news from a double-digit percentage decline for the industry, but we're chasing the forecast up right now, and that's a good place to be. Some points that are worth noting. We are seeing builders use price discounting to help improve sales. We'll get new home sales for May next week. We're expecting a really good number relative to April, but some of that's being driven by price cuts. About a fifth of builders say they're using price incentives, and it's affecting that blue line, which is the typical price of a newly built home. Now, the red line is the typical price of a resale home that we get from NAR. And the gap between the two is really useful because the black dashed line is a measure of that gap. You can see the gap was the biggest roughly in 2015, 2016, almost $100,000. And then since 2018, that gap has been closing. And the reason the gap is closing is because listings are down, inventory of resale is really tight. So that red line with seasonal movement continues to trend higher. And the blue line with some statistical noise has roughly been flat since 2017. So the gap between these two series are closing. Now, this is the reason the home prices continue to go up, because the Case-Shiller index of home prices is just resales. It doesn't include new construction. It is tracking when a home sales and then when it sells again. It's a resale index. So the reason that the Case-Shiller index is going up 5 to 6% year over year, or larger than that in certain metros, is the fact that there's just not much inventory of that resale activity. Builders are using incentives to compete. So that's kept profit margins compressed, but it is helping sales volume. And then the geography of building is going to change. Now, we talked about this at the beginning, more people telecommuting, sensitivity to housing affordability issues. We've got Clark County. You can look at the kind of the greater, say, Portland metro area. This is one of the counties that we've got marked on our home building geography index as within a large metro suburban market. This represents, these blue counties represents about 26% of single family construction. And we do think that these areas, which includes area that I live in outside Washington, which kind of represent the inner suburbs, are going to grow compared to the core counties in white that they surround. The core counties are going to experience some flight, and it's a consequence of the virus itself and dependency on mass transit and density factors. So these areas are going to grow at the expense of those core areas and probably help support things like townhouse construction, medium density neighborhoods, anything that allows individuals to not live in a building, say with an elevator. Elevators to me are the new choke point until we get a really truly effective vaccine, because elevators limit the amount of people that can be moving up and down at a given moment. And then growing further still, so a little further out from where you are, these areas in brown, orange, yellow, and red are the lowest density markets. So for example, the areas in brown and orange are small metros, yellow are roughly small towns, and the red are rural areas. And they represent 47% of single family construction. They don't get the media attention that the areas in white do, because there are smaller markets. But in the data that we looked at in the first quarter, these areas were growing faster still than all the counties in white. So there was already a decentralization trend in place because of regulatory burdens and land costs. And I think the virus, like it's going to do for everything else, is accelerating those trends. So we're going to look for additional growth in these areas, particularly for single family housing. Some other trends that are going to continue to change. Here we've got a pivot point. New home size has been falling for the last 3 or 4 years. We think that's going to level off and begin to increase. It shows up in the, anecdotally as well as in the survey data, that people want more space. They're working at home more. They're going to want more home offices. So we do think that's good for single family construction. It's good for suppliers in terms of selling items to go in homes, and it's good for remodeling activity. A subsector that I have not been particularly cheerleading in the last few years, I've sort of always been noting that's been small. That's single family built for rent. It's about 4% of single family construction, but I think there's a window of opportunity, maybe about 18 months, where the demand for this kind of housing is going to go up. You're going to have more individuals who want to rent a single family home because they don't have the down payment. So if you're already in this market, it's probably a good place to be. I would not encourage people who aren't in this market to necessarily go into it, because you could have a whole bunch of people chasing into it at the same time. That'll depress returns. But there is some heightened demand for this particular market, and I wouldn't be surprised to see the market share, which is marked in red here, increase. Apartment construction. Here we've got a flip from the Great Recession. In the Great Recession, multifamily construction responded first and recovered first and did well. Here, multifamily construction is the weak leg of home building. This is a commercial real estate crisis, and multifamily is closer connected to commercial real estate than obviously single family built for sale. So for our forecast in terms of apartment development, I've got negative 21% in 2020. That's remained relatively constant. And then for next year, I've got pretty strong growth. And I got to tell you, we've got the NAHB board meetings going on this week. Apartment developers there have told me that they think in 2021, I'm being a little too optimistic for 2021 due to lending constraints. So I've got it returning to trend based on demographics, but there are lingering concerns in the apartment market. And we think, by the way, that the types of buildings for apartments are going to change. The blue bars is the share of apartments being built in 50 plus units. That share has been going up over the last 2 decades, more than half of units now. That blue bar is going to shrink and the red bar is going to grow. We're going to see more medium density rather than high-rise apartments going forward. And then remodeling. Remodeling, I too have revised up. We've now got it flat. We think it's going to weather this particular storm fairly well because of the emphasis on home. And I mentioned before, people want more space. Initially, I thought it was just going to be exterior remodeling that would fare pretty well. We're even seeing data now that suggests interior remodeling is doing pretty well. And I mentioned it before, but the emphasis on home. We have seen over the last 15 years, more people wanting exercise rooms, more people wanting home offices. We think those trends are going to continue. We're doing our 2020 consumer preference survey right now. It's just been mailed out. I would not be surprised to see this trend continue in terms of people wanting dedicated space in their homes so they can avoid public spaces, even with a vaccine that we likely think is coming sometime next year. And then lastly, look, it's still an election year. We've got here marked out red counties and blue counties based on how they voted in 2016. It's worth noting the red counties, 61% of single family construction. They were growing faster. I think it's kind of just a reminder that local elections matter, that regulatory burdens really matter when it comes to home construction. And, we'll see how the election shakes out, but that too will change how some of the geography of home construction changes going forward. So just wrapping up, we're at the end of that 2-month pause. The virus spread will slow, but we certainly believe risks remain. I think there's I was going to say probability, a possibility of a baby boom occurring. Millennials have not had kids, certainly at the rates at which Gen Xers and baby boomers have had. I think that might change over the next 2 to 4 years, and that could affect housing demand. So we're in the 2-quarter period of the stabilization. We think it's going to take about 2 years to get back to trend. But generally speaking, we're in that rebound mode. We'll have to watch the fall in terms of the virus itself, but certainly the housing data is overperforming. And that is our national outlook. I'm happy to stop and take any questions.
Thank you, Robert. I think Andrea is going to be triaging questions. If you want to raise your hand or type something in the chat window, she can take care of that. But to start out, I had a question, and it's pretty esoteric, so I'm not sure if you can go there. But in the past, with your experience, have you seen market forces being able to overcome regulations that are designed to force urban density, regardless of the market? We're under a Growth Management Act here, and policies that basically keep adding with basically cost doesn't matter. It's designed to push for urban density, and so our housing prices are staying high and probably going to keep going up. And only so many people can afford a house, right? So I'm not specifically asking about does it change regulation, but have you seen where market forces push to moving out of the dense urban areas in states where they have a very strict regulation or regulatory environment?
What's the quote from the original Jurassic Park movie? Life finds a way.
Yeah.
Markets find a way. People vote with their feet. Unless you have a complete government-controlled economy, people are going to find a way to evade rules that don't make a lot of sense. And so the question I often got at the Builder Show each year was, how's home construction in California doing? And my response was a simple one. I'm like, oh, home construction in California is doing great. It's building a lot of homes in Boise, Idaho, and Fort Collins, Colorado. And so that's how you see it. You see, in terms of the regional drivers, the fact that when we look at tax data and postal data and the like, you see people who ordinarily should be living in places like California, and then frankly, Seattle and Portland, and they're moving to lower cost areas. We've seen it in Eastern Washington. We've seen growth along places like Columbus, Ohio, that's coming out of the expense of some of the East Coast clusters. So the biggest growth areas in terms of population and home construction continue to be the South and the mountain states. And it's no surprise that they also have the lowest regulatory burdens when it comes to things like impact fees and zoning rules. Part of the fun of my job is that I get to tour markets all over the country. Your market is a more regulated one, and then I'll go and I'll visit a place like in Texas or in Florida, and they'll complain about a $500 increase in an impact fee as if it were the end of the world. And I have to be sympathetic. In percentage terms, that might be really high, but I have to remind them, you should see what building has to go through in places outside some of the large metro areas. So your question's well founded. Local regulations matter, and I'm not a guy who says we shouldn't have any regulations, but there are plenty of economists at Harvard. There's a great line that says no individual regulation has a bigger harm on individual American households than zoning rules. Because what they do is they deter economic activity, they increase the cost of housing, whether it's rental or for sale, and they act as a huge tax. So we spend a lot of time fighting about tax policy, but it's really how we use land that really has an impact on the well-being of ordinary Americans.
Great, thank you, Robert. Andrea, did you have any questions? Did anybody pose any questions, or does anybody want to raise their hand or pose a question for Robert since we have him here?
Yeah, no questions over here. So if anybody wants to ask a question, feel free to type it in the chat box or unmute yourself and ask it.
Sure. And while we wait to see if anyone's got one, I'll make sure the staff, the BIA, has a PDF copy of the deck so you can take a look at it. We tend to go through some of this stuff pretty quickly. I know people are like, the map's gone. I'm still looking at it, but I'm happy to send a PDF of it out. It doesn't look like we got anything.
So actually, Robert, I have a question. I think it was like last week or someone, we had the unemployment numbers are very good. There's a market change, but in some of the other, not yours, but some of the other presentations I heard, there was some reporting problems. It wasn't political, it wasn't intentional. There was some misreporting. Is that true, or do we know?
One, it was not political. Two, what happened was there's two surveys, and even I've watched some of the other industry events. They're not doing a good job of distinguishing how these things are technically built. There's the payroll employment survey, which is a business-based survey. Those numbers are fine. And those were the ones that showed we gained 2 million jobs last month. So the directional change is there. Where there was an issue was in the household level survey, which is a survey of ordinary individuals. And you fill it out and you basically say, I'm in the labor force looking for a job, I hold a job. And there's a line where you can click and say, I'm employed, but I'm not at work this week. And ordinarily what the BLS uses that for is I'm sick, or I'm caretaking. Well, what we think is a lot of people who are on furlough check that line, and it was well above historic norms. So there was two conclusions from it. Huge number of people were sick, which in this environment we couldn't necessarily rule out. But even if we kind of use some numbers related to the virus, what it suggested was rather than 13.3, the real unemployment rate was 16.3. Now that's still a terrible number, but wow, it is so much better than the 20 to 25% rates that some people had pulled from the layoff data. That's the weekly jobless claims numbers that we got one today. What they were doing was they were adding up the total number of jobless claims being reported and said, okay, we lost 40 million jobs. The unemployment rate must be 22%. Well, we weren't doing that because those jobless claim numbers they're not garbage, but they're not great. There's a lot of people who apply for jobless claims 2 or 3 times because they're frustrated. The states don't do a particularly good job of recording them. So we track those numbers, but we never work with them and add them up to try to calculate an unemployment rate. And in fact, even if you do that, if you do it carefully, it suggests the unemployment rate's about 15%. So we got a lot of data points that are all kind of pointing to mid double-digit unemployment rates. That's where we think they are. And like I said, we think it's going to come down to about 10% by the end of the year.
Thanks.
All right.
Actually, Robert, I had a question for you. This is Brent with Gary's
Yeah,
Vacuum Flow. Have you guys looked at how, you had mentioned in your presentation the import of products and challenges with that? Most of our products about 85% of our products are made right here in the US. So we don't see huge increases with our products, but from an overall housing standpoint nationally, cabinets, sinks, toilets, soft lumber, softwoods, do you see that affecting, is that going to become more of a challenge in the next 18 to 24 months with the cost of those goods increasing because of the stress on imports?
It's going to come and go, and it's going to be highly regionalized. So we were doing weekly online surveying and asking that question, what from a builder or remodeler perspective, how is your ability to access building materials? And it was really bad when things, say early April, it then began to improve, and now I'm hearing that it's growing again. So what you're seeing is the ebb and flow of the declines and then the reacceleration of construction activity. Once a week, I seem to be dragged onto a conference call somewhere in the Carolinas, somewhere in Florida, somewhere in Texas, where they want to discuss the fact that building material products are growing more scarce. So it seems to popping up all over the place. And then this week is the NAHB Summer Spring Leadership Council meeting. Just talking to people in various Zoom meetings, we're having networking events and things like that. That's it's a little strange, but that's how we're interacting with people. I'm hearing a lot of people say, look, this is a growing problem. We think it's going to continue. So what does that mean? Well, in your example, if you're in a product chain that's got domestic manufacturing sourcing, you do have a relative advantage. The concerns I've heard about are building product materials that are manufactured predominantly outside the US. And by the way, it's not just China. I didn't want to make it look like I was picking on China. I had good examples of things that were made in South America, for example. And while the factories are up and running, some of the challenges were that the actual shipping is really constrained. So when international passenger traffic on airliners shut down, I always thought of, what goes on an airplane underneath the passengers. Well, it's the luggage, right? No, there's a huge amount of goods shipments that go on those flights. And so when those flights canceled, the pipeline for global trade shrank. And then it goes beyond that. Shipping traffic, actual large boats. Some of these boats don't leave port until they're full. And so with declines in other kinds of manufacturing or trade, those boats aren't going as frequently. So all of these things create these kind of disruption effects. I think that's going to continue for the next 2 to 3 quarters.
Thank you.
Hey, Robert, we do have a question for you.
Yeah.
Do you see fewer people moving from state to state with the fear of the virus looming?
Yes, but only within a certain submarket. So we are seeing and hearing about, and this is concentrated in places like Phoenix and Florida, baby boomers. So there was a big amount of people Northeast, the Midwest, moving to places like the Carolinas, Georgia, and Florida. That has slowed. In terms of people, Gen X, millennials moving state to state, that could actually increase. In fact, there's good evidence right now in the New York area. There are plenty of people moving all over the place because of the fact that their employers have basically told them for at least a year, you can telecommute. So you've got people moving, to the Midwest who previously were living in Manhattan. So that state to state dynamic is picking up. You can look at things like U-Haul traffic. And by the way, if you haven't used Google Trends, just for your own business forecasting purpose, I recommend it. I mean, it's cheap and easy to use. It's free data. But for example, we use the Google Trends on moving truck. How many people are searching for moving truck? And you get this nice seasonal pattern. You can run all kinds of mathematical models through it. But yeah, you could look up things like state to state moves or New York to Utah movers, or to track that kind of stuff. And you definitely see an increase. So the boomer side has slowed down because of the virus. Everything else is picking up.
Great, thank you.
Yeah. Any other questions?
Well, Robert, thank you for your time today. I really appreciate you coming on here and giving this update. I'm glad to hear that some of the numbers are better than we thought, but there's a chance, cautious optimism there is definitely appreciated. So thank you so very much for that. Thank you, Columbia Credit Union, for sponsoring this event today. Sorry about that. We really appreciate your sponsorship, for this and for all the events. You're very active in our organization. If any of you have questions after the event, feel free to send me one, Ryan at biaofclarkcounty.org, or you can also send it to Andrea, same domain, just Andrea instead of Ryan. We can take care of those for you, and I believe Andrea will be giving a wrap up after this that we will distribute out once we get it processed, including a link to the video. Anything else you would like to add, Andrea?
No, I think that's it. Yeah, we'll get that video up and we'll send a link out to everyone with the slide deck as well.
Thank you, everyone. We really appreciate you today coming on. I think Andrea and Danielle are setting up more of these. We'll keep you in the loop on that. We also, a lot of you have participated in our weekly webinar that I kind of host. We have moved to bi-weekly just because some of the COVID compliance stuff is slowed down. So our next one of those will be the 30th, to be decided what the subject matter is. If you have an idea or something you want to hear about from either my webinars or the educational webinars such as this that Andrea is setting up, or Danielle, please shoot one of us an email and we'll try to get the correct or the right experts here like Robert was so kind to join us today. Thank you, everyone. Have a wonderful day and have a wonderful weekend. Go out there and enjoy this great weather.
Thanks, you guys. Thank you, Robert.